Halloween is over, but deflation and demand ghosts remain. Thank you for joining us for another Bank of Cardiff newscast. Factors, equipment finance firms and banks of all sizes have expanded their balance sheets thanks to a tidal wave of liquidity created by the 5 years of expansionary global monetary policy. But record stimulus coordinated in an unprecedented way around the globe has only resulted in middling inflation to date, just as many financial players lay bets that the Federal Reserve under Janet Yellen will raise short-term interest rates in 2015 for the first time since the crisis. The specters of falling demand and falling prices rear their ugly heads. Any signals worth noting are mixed and still uncertain, but data suggests the Fed should not remove the financial sector's monetary punch bowl just yet. So, what's the global picture? Well, we first turn to global prices. Headlines about any type of inflation, whether it's inflation or deflation, are always negative. Both are bad and scary according to the pundits. Central bankers have spent most of their lives studying how to keep the economy on a skate's edge of controlled inflation without tipping into the realm of deflation and broadly falling price levels. Chinese consumer inflation slowed to just 1.6% year over year in September, and that's its lowest reading since 2009, just as producer prices slid 1.8%. US and UK inflation has slowed in recent months, but prices haven't contracted. Globalization leaves today's central bankers with possibly more limited tool belts to control monetary forces than can cross borders as quickly as most goods and services do in the internet age. Long-term government bond yields around the world are pricing in near zero inflation for the foreseeable future, and falling commodity prices help cement investors' conviction of late that prices aren't going up. The nightly news explains falling gas prices as a positive for middle-class consumers, but they forget that periods of powerful economic growth yield higher demand and higher prices. New oil discoveries have been used to explain some of the price decline, but other commodities, including metals, have been falling in tandem. Should we be worried? Well, although the cost of deflation to lenders is potentially huge, fears should be placed in context. Falling prices cause a transfer of wealth from borrowers and holders of illiquid assets to savers, and those with big piles of cash. Deflation can discourage private investment because there are reduced expectations on future profits when future prices are lower. But modern central bankers are using quantitative easing quickly and efficiently, having learned both Japan's errors from the lost decade and the Fed's Great Depression-era mistakes. They can buy and sell a variety of non-traditional fixed income instruments in the open market to impact global money supply. Now, there's no reason not to have every confidence that central banks will fight falling demand and prices tooth and nail. With deflation fears set aside, we turn our attention to an increasingly competitive financial marketplace, signaling potential shifts in lenders' ability to grow top and bottom line results. Growth now seems tied to compromising the underwriting guidelines that could help avert another global financial crisis. There are signs that the supply of financial products is quickly catching up with demand, just as the Federal Reserve winds down quantitative easing stimulus designed to stave off deflation and boost capital demand from businesses and consumers. Demand for large and mid-ticket infrastructure and equipment loans from large public and private companies notably tightened as yield spreads compressed over the past few years. The number of new customers and projects has not kept pace with the supply of new dollars chasing those customers. Now, this isn't difficult to understand when central banks are pumping new liquidity into capital markets on a daily basis. Now, the lower end of the market for small ticket equipment and working capital loans under $250,000 is facing a similar fate. The Bank of Cardiff monitors small business marketing response rates from millions of small businesses in a wide array of industries and with wide-ranging borrowing histories, inclusive of factoring, equipment leasing with banks and independents, ranging from those with top-tier to sub-prime credit appetites, SBA loans, and traditional large bank lines of credit. The demand side of the equation is surely beginning to feel overwhelmed. This does not necessarily signal anything tawdry about an economy growing at 2 to 3%. Rather, the appetite of financial firms for assets is simply outpacing these borrowers' appetites. It becomes increasingly attractive to push the gas pedal in the face of stiff competition. That means removing structural barriers to risky transactions with smaller security deposits, easier seasonal structures, and more limited collateral where logic dictated these enhancements in the past. Lower credit standards are almost sure to follow, pushing rates down for lower-tier customers with higher application-only limits. The smallest businesses with satisfactory owner's credit scores can add enormous leverage with no review of their financials by shopping around to a few brokers and direct lenders in short order. Financial industry players agree that demand is not at the same level as the peak of 2007-2008, but marketing and advertising budgets attacking a relatively finite group of small business counted in the single-digit millions, and they're far in excess of that peak. Credit card issuers and business lenders are not likely to share their response metrics with anyone, let alone publications read by their competitors. And there's little interest in paying attention to noise-like fluctuations under 20% month to month. Suffice it to say that response erosion has been steadily in effect throughout 2014, and while concerning in Q1, Q2, it reached a frightening 40 to 50% by Q3 of 2014. The largest players are best equipped to survive this cycle like others before it. They can pick and choose how their deals are originated. If their direct sales force gets in trouble, they shift to niche third-party originators. If direct mail fails, they can shift to telemarketing and online ads, but it's clear that the Federal Reserve must avert raising rates in the near term, meaning that the risk of falling prices, along with economic contraction, far outweigh the central bank's need to ratchet up short-term interest rates to avert unruly inflation. These factors bear watching even as the US economy seems on surer footing than many global economies and the stock market is near all-time highs. In a dangerous confluence of events, Janet Yellen's Fed could confront the strengthening economy with too much monetary tightening, thereby inverting a yield curve that still looks healthy by historical standards with yield spreads in excess of 2%. The media is unsure whether to focus on inflation or deflation as the right omen of nasty economic trends. From our point of view, battling inflation doesn't make a lot of sense at a time when the economy is on unsure enough footing that financial product yield spreads are compressing and the power of each marketing dollar seems to be in free fall. Join us later this week for another Bank of Cardiff newscast, and remember that all of our newscasts are available on our website www.bankofcardiff.com/newscasts.